This week, we will be finishing up last week's dividend strategy with some picks that we think are good picks.
And we'll also give important market levels for next week.
Alright, let's not waste any time. But first, you know the rules. Give a thumbs up buttons, a tap if you like the videos.
Sweet. So dividend strategy is a broad idea. Obviously, we can't just go for any companies that pays dividend. If that's the case, then you can totally skip this video right now and just Google stocks with the highest yield. We need to combine global economic and market state.
Yup, things not happening in the US still has great impact on the stock market here. For example, the rise of Delta variants in India and Europe earlier, global supply chains issues, and China's big tech crackdown.
And within the US, the increasing shipping costs and labor shortage are currently reflecting on the stock market, which is why if you look at these companies that are sensitive to the economic cycle are underperforming, such as airlines, travel, entertainment, and your industrial sectors.
True, but also the stock market usually starts bouncing when the economy outlook hits rock bottom. You know, as they say, it can't get any worse, or no more bad news mean good news.
Yeah, exactly. So personally, I think we will soon be back to the economic recovery place, just like the sector rotation earlier in the beginning of this year. And these economic recovery plays are where the blue chip dividend stocks are at.
The first sector is
This
healthcare.
is one of the country's
Recently,
busiest
healthcare hasn't been
hospitals,
doing very
LA
well
County
lately
USC
due to the
Medical
pandemic
Center.
taking up too much resources. Some other
Now
medical
treating the
areas are
poorest
being
and
neglected
sickest COVID
beside
patients in all
COVID
of Los
cure and
Angeles,
prevention.
where hospitalizations
But
and
we
deaths
think this is actually a good
skyrocketed
time
in
to start
July.
getting involved in
That is a
healthcare.
huge toll to take every
Currently,
day,
the sector as a whole has
knowing that you're the
low
only person
valuation, and they're going to
or maybe the
benefit
last
from
person who speaks
post-pandemic
to them.
era where
And it's a
regular
toll
medical
that pushed
services
this
are back to normal
hospital
volume.
and its workers
And
to the brink.
also, as the baby boomers are getting older, the demand will
Tell the
increase
story of our
organically.
patients. Tell
Yup,
the
if you
story
are
of our
still not so
exhausted
clear on the
staff
logic
who are
behind
running
healthcare,
towards the
check
danger.
out this video
Dr.
from
Brad
August in the
Spellberg is the
description
chief
down
medical
below.
officer here.
So in this
On the front
sector, we
lines,
like Johnson & Johnson. The ticker is J&J. It has 2.6% yield and only zero point 0.7 beta. It's a pretty good defensive pick.
And recently, research shows that the Johnson vaccine is 94% effective against COVID after 2 shots. The stock has pulled back about 10% from recent high. Could be a good spot to get involved. I like to point out on regulation risks. Biden's healthcare plan is putting a limit on some drugs' price. We need to watch out for this.
But next sector is industrial. They went through a nice pullback lately and have that bouncing potential soon. I like Caterpillar. It's the biggest infrastructure equipment manufacturer.
Looking at CAT, the yield is about 2.27%. Beta is okay at 0.93. I like how it is a sure thing in economic recovery in the future, especially with Biden's infrastructure plan.
I agree. The stock dropped almost 20% from recent high. PE is reasonable around 24.
The next one is banking sector. The sector not only benefits from economic recovery, but also long-term rate hikes.
That's right. If we look at the pandemic effect on the banking sector, it really didn't hurt it that much. It actually kind of helped it. So in order to prepare for the risks, the banks stopped paying dividend and stock buybacks. But they realized the cash reserve for the risk, like defaults, is not really needed. Now, what do they do with the extra cash?
I guess they just return it back to the shareholders. Looking at these big banks announcing dividend raises, JP Morgan did a 11% raise, Bank of America raised 17%, Goldman raised 60%, Morgan Stanley and Wells Fargo both double.
Within these banks, I like JP Morgan. The yield is 2.3%, and for being a traditional commercial bank, it will for sure benefit from long-term interest rates. Its business is also very diversified, so it's a safer pick in this uncertain market.
These are our recommendations. Let us know what you think below in the comment section. And again, we are not telling you to buy these tomorrow. Use our logic. Do some research.
Yeah, I like to get your opinion all the time, but when I do my homework and get to know a bit more about the company I'm buying, I realize I panic sell a lot less.
Yup, and before we move on to the next topic, we want to remind you on using the dividend strategy. First, higher yield is not necessarily better. For example, AT&T's yield is way over 7%, which is higher than the picks we made before. But the reason is largely because of its dropping stock price. It dropped about 30% in the past 5 years. The takeaway from this is we need to consider the company growth potential as well when we picking our dividend portfolio.
Very true. Also, just because a company pays dividend, it doesn't mean that it is consistent like a lot of blue chip dividend payers. Some companies try to paint a false sense of being consistent in revenue and being risk resistant. They'll borrow money to pay dividend, and we don't touch those companies with a 10-foot pole.
How can we tell these companies from others?
So, yeah, there's an easy way. We can check their payout ratio, which is dividend divided by EPS. So, basically, the percentage of the company's earnings, and the higher the payout ratio, the higher the stress on the company paying dividend, and less likely for the company to continuously pay dividend in the future. If the company is borrowing to pay dividend, the payout ratio will be greater than 1, which means they're paying more than what they have earned.
Okay, that's cool. And lastly, and most importantly, we can rely on dividend strategy as a main investing strategy. We should use it to diversify our portfolio. During the high uncertainty times, it can be defensive. And during a more stable period, we can use it to diversify and risk manage.
President Joe Biden met with some of Wall Street's top CEOs on Wednesday to address the debt ceiling and stress that it's delaying an increase to the borrowing limit, which will put us in a very bad spot.
The clock is ticking. Congress has only 12 days until October 18 to do something before the US defaults on its debt for the first time ever.
We could see a dramatic rise in interest rates across the country, and weakened US dollar. Foreign investors would lose faith in the US market, and then, stock market will tumble.
So, in another word, this could trigger a recession.
It could, and no social security checks to all the boomers out there, and US armed services might not even get paid on time.
Well, sure, there are a lot more consequences, but I'm sure they will probably figure something out, right?
The CEO who attended the meetings didn't really offer their thoughts during the meeting, but I'm sure they already know what's up, and I happened to pass by their conference room and overheard some of their discussion.
What did they talk about?
Well, Biden was asking the CEO to take the other side of the party out for a nice dinner and try to talk them into an agreement and stop making it so difficult for him. His reputation has already taken a big dip.
That's true. I'm sure they are also good friends with them too. But why would they do such a favor for President Biden? Just because he's the president?
Well, he hinted that Jerome Powell's term is ending February 2022. And he said he might let them choose the next, Fed chair.
Wow, I'm sure that will be very tempted if that's the case.
Well, guess what? On Thursday, by a 50-48 vote, the Democratic-led Senate approved a 2-month extension.
I am this much closer to believing you. Anyway, I'm glad that they gave each other more time to figure things out. Let's take a quick look at this market.
The market cheered on this news, and all major indices bounced nicely on Thursday.
Yep, the market dipped on Friday after September job report missed estimates. The US added 194,000 jobs in September, missing forecast for 500,000, and below August revised reading of 366,000. But the employment rate also fell to 4.8%, another new low since COVID. Probably because unemployment benefit ended for a lot of people.
Well, this is a pretty bad miss. I don't think this weakened job number is going to change the Fed's tapering plan, around November.
Well, in case you wonder, if the Fed begins tapering its assets purchases, that means less money will move into the bond market, which could bring the bond prices down and lift up the yield. Generally, higher bond yield means lower stock market valuation or less valuable.
So pretty much NASDAQ is going to dip if that happens. Looking at the chart, NASDAQ closed the week flat and parked at support around 14,790. Most likely, we're going to test the upper resistance at 15,160.
The Dow Jones closed the week above 1% carried by UNH, GS, and HD and are the top performers of the weeks. Nice rebound from the support around 33,800, and we need to take out 35,050 upper resistance before heading higher.
And Russell, small cap. The triangle is narrowing down, so place your bet now on which way it's going to break out.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.